What comes next is anybody's guess, but from Michael Burry's point of view, the markets will continue to fall, and so far, he's been able to add another ribbon to his chest of medals by correctly predicting market bubbles and making himself a hell of a lot of money in the meantime. Some people aren't convinced by his arguments. Some claim Burry is a one-hit wonder and doesn't know what he's talking about. Some claim he's predicted more crashes than he's ever seen, but most are cautious and worried because the economic environment growing right now is bad and it just keeps getting worse. Maybe the bubble has already popped and we just don't know it yet. Michael Burry has designated a new target, and this time it's the bubble surrounding index fund investing and passive investing. He's going all out once again. Today, we're going to establish just what he's claiming, why he's making these claims, and what it all means. Burry is telling us that the passive investing bubble has already popped, we just don't know it yet. Michael Burry has been an infamous investor ever since the film The Big Short was released, detailing his moves to shorten the housing market in 2008. But his history of calling out bubbles and making millions of dollars in the process far predates that, and he's kept on going since then as well. In the wake of the COVID pandemic, Burry once again put his skeptical hat on and shorted the market, and after a bleeding 2020 with stocks losing value week after week and month after month, few were brave enough to still claim he was wrong. Passive investing, for those who don't know, is the opposite of active investing. Instead of actively picking stocks and trawling through financial statements and future growth reports trying to work out which companies will do well in the future, you simply put your money into a broad basket of stocks and trust that on average, the value of all those companies together will increase. Burry thinks this is a problem, though, and that's what sets this current market apart from previous bubbles. Burry tweeted, "The difference between now and 2000 is the passive investing bubble that has inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out is by trampling each other, and still, the door is only so big." Unfortunately, though Burry is also pretty clear about how fast he thinks, this is going to go down as well. From his point of view, the recession has kicked in when people start to lose their homes, their cars, and their jobs when they have to make the tough decision to go hungry or go cold. Well, they will liquidate their portfolios and sell their passive investments no matter how much they've lost, and that will trigger the final collapse of this bubble as it culminates in the same way all bubbles do. Too many people have just sat around following the age-old investing advice of chucking a few $100s into the S&P 500 each month, and these people are all unaware of the problems this has caused. At some point, the roots will start and people will start to liquidate their positions, but the door is only so big, as Burry says, and not everyone can get out alive. Burry isn't just posting cryptic tweets, he's warning us of what's to come. About a year ago, he posted a link to an academic research article called In Search of the Origins of Financial Fluctuations. Despite its rather dull name, the paper is very interesting and supports the idea that there's a bubble for passive investing. Burry summarized the article by saying if $5 incremental market value results from $1 added to stocks and 90% of millennials, also known as future wealth owners, are in passive market vehicles, that 5-to-1 ratio will get much, much sillier in time. COVID didn't stop it, inflation might or not. He further added that the first step to recognize that 5-to-1 is not a natural ratio. It's the product of a paradigm. So how will this paradigm continue? How may I reverse it? This is the knife's edge because we're at 5-to-1. It may go from 100-to-1 or become negative 5-to-1, but parabolas don't resolve sideways. What Burry has talked about and what that academic article he linked to proves is that when you put $1 into an index fund, the nature of the level average margin and other forms of debt means that the index increases in value by $5 and thus a bubble is born. Now, Burry recognized this back in September of 2021, or 3 months before the 2022 bear market began, and we saw the top, but he didn't even know exactly where this would go. 5-to-1 is not a natural ratio. It's a product of a paradigm, and that paradigm is the Federal Reserve. It's fractional reserve banking. It's a fiat currency, and its debt creation, but we're witnessing a change in our monetary environment right now as we speak, with interest rates rising and quantitative easing being replaced with quantitative tightening. This may be a paradigm shift in inflation. Following the COVID pandemic is what finally breaks this crooked system. As Burry just said, parabolas won't resolve sideways. This will either melt up or it will melt down. Burry's also put out some not so cryptic tweets lamenting the lack of sensible active investors these days. I get the sense that in 2002 there were more value hedge funds than there are value investors today. From his point of view, value investors are vital for a functioning market as they determine what price assets should trade at, and a lack of those investors means a lack of pricing pressure in the correct direction. Without them, a passive investing bubble and bubbles of other types are far more likely to emerge, and that's exactly what we saw over the last few years as those investors who were actively concentrated on hype and growth, with the worst of them all being Cathie Wood, a woman who lived in the clouds and convinced herself that this time it was different. Burry certainly thinks the pain isn't over and that there's more to come, and that passive investing will play a major part in the history books, or as he puts it, you have no idea how short I am. Of course, there are other indicators you can look at to try and identify a bubble from index funds as well. Most notable is the Buffett indicator, named after none other than Warren Buffett himself. It's a basic principle, but there are a few different versions. Some claim it's a total value of all US stocks compared to the country's GDP. Some claim it's the difference in value between the S&P 500 and the Wilshire 5000 and the US economy. But what we all agree on is that it all measures the valuation of American stocks compared to economic activity, and that indicator was screaming at us by the end of 2021. When stocks are expensive, when they're in a bubble, the indicator rises, and historically it is held. In the 20th century, the indicator would usually sit between 50 and 100%, but it rose drastically during the dot-com bubble up to 140% at its peak. Then, over the last few years, as quantitative easing and money printing have exploded, the indicator started to rise again, this time reaching a monumental high of just over 200%, the worst we've ever seen. Since the end of 2022, though, stock prices have been falling, as we all know, and so has the indicator, but it's still sitting at above 150%, far higher than it had been before this bubble, indicating pain may not be over and that the passive investing bubble may still be in full swing. Many people listen to these claims and they don't understand how they could even be in an index fund bubble. From their point of view, index funds are supposed to ensure that there aren't any bubbles. You just invest your money into the market as a whole, so no singular company like Pets.com gets extra attention. There's no euphoria or emotion when it comes to investing through index funds, so the market should function appropriately and price assets reasonably. Unfortunately, index fund bubbles can exist, and it's due to their nature, not despite it. While there is value to the idea that you don't pay attention to any individual stocks in the market with index funds, it also presents a massive problem. Tesla, over the last couple of years, has been a brilliant example because of the size to which that stock has grown. It's no secret that many people think Tesla has been a bubble, and one of those sounding the alarm has been Michael Burry over recent years. At its peak, Tesla was worth around $1.3 trillion and was one of the most valuable publicly traded companies in the world, making about 3% of the entire market cap of the S&P 500, which meant that when someone went to invest in the S&P 500, they were putting 3% of their money into Tesla, whether or not they knew it. This contributed to increased buying pressure for Tesla, and that would all have caused its price to go even higher. Because this is being done through an index fund, none of these investors are partaking in price discovery at all either. So to them, it doesn't matter how much Tesla is worth. They'll keep buying it anyway as long as they invest their monthly $500 into the S&P 500. At the same time, as this was happening for Tesla, Apple was worth just under $3 trillion and made up over 7% of the entire S&P 500, and so it was also seeing huge amounts of inflows from investors who weren't paying attention to its price. These companies were getting bigger purely because they were already big. They were getting more investors purely because they already had investors. There was no element of price discovery from the billions of dollars flooding into these companies via index funds, and with no price discovery, we saw bubbles grow. Of course, this also happens across companies of every single scale and affects every single company in the S&P 500, as it's such a dominant index that no matter where you go for advice, people will tell you the same thing: invest in the S&P 500. So any company in the index is just going to innately have more attention and more investors and more buying pressure than a company outside the S&P 500 would have, and so we're seeing their values grow. These inflows create strong returns, and that pushes further investment, pushing the value of the index up further again. So it isn't even just the case that index fund investing can cause and create bubbles in individual stocks, but it can lead to a bubble in the entire index itself, and that's what many fear we see in the post COVID environment. With millions of people sitting around with cash burning holes in their pockets, they turn to easy and used and fun investing apps like Robinhood and put their money to work. Index funds and their popularity have never been so great, and so we saw the growth of the world's first major index fund bubble, at least according to Michael Burry. Now, at the end of 2022, we've all been seeing the markets decline all year. It seems incredibly likely that we're seeing the first ever index fund bubble crash. Thankfully, the nature of index fund investing is far more passive than any other types of investing, so fewer people cash out when fears strike their hearts, and that's likely why this bubble hasn't exactly popped yet. Instead, it's just been deflating. If you want more content like this, then like, comment, and subscribe to the channel.